Sell the rips or buy the dips? Today, we're going to talk about what's next for the market. As you guys know, over the past 3 months, I have correctly predicted that the market would have a pullback. In fact, I don't need to predict. I looked at evidence and it was overwhelming to suggest that the market would have a pullback. So far, so good. Last week on my video, if you watched that, you'll note that I suggested that technical indicators were pointing towards an oversold rally. And Thursday and Friday of last week, we got that rally. The question I'm sure on everybody's mind is, what's next? So we're going to take a look at whether this is a correction within a bear market with a quick rally and then more downside, or if this is the beginning of the end of this correction and we get back into a strong bull market. My name is Keith Richards. I'm a technical analyst. I'm president of Value Trend Wealth Management. And we're going to talk about a lot of stuff today, and be sure to stick around to the end, because at the end, I'm going to talk about 3 specific ideas that has helped Value Trend earn positive returns both year to date and month to date, how we've accomplished that, and what you can do to stabilize your portfolio in uncertain times. Let's get started. Okay, well, I want to start off with the bull case. And really, there is an argument that this is just a correction within a bull market, and the correction may be ending. So let's just take a look at that argument. So the first thing I want to look at is the pullback extent, or the percentage pullback that we've seen, and compare that to data over the last couple of years. We're just kind of looking at a relatively short-term period of time, but I think it's important to get a context of what this pullback has looked like. Well, as you can see on this chart, we saw about a 10% pullback, and that's right here on the chart. And then we also have seen over the past couple of years similar pullbacks, such as August of 24, not quite 10%, and then in 2023, in the fall around October, we saw a similar pullback to right now, which is about 10%. So this is nothing unusual. And so that brings us to our next chart, which is that of the S&P 500. So as you can see, I've circled on this chart that the October pullback in 23, the August pullback in 24, and the recent pullback were nothing but interim corrections within a longer uptrend. So this is good news if you're a bull investor, because this has happened before, this kind of pullback, so maybe it's nothing to worry about. Now, I'm just going to erase a couple of my lines here because I want to take a look specifically at 2023. And the reason I'm looking at 2023 is because it extended a pullback that is very typical for market pullbacks. Markets often pull back in 3 waves. So this is an Elliott wave principle. I'm not really an Elliottician, but nevertheless, I have noticed that bigger moves move in 3 waves on the downside. So you can see that happen in 23. The market was moving up, it had a correction, it moved back up on a rally, and then it did a final fallout. And that might be what's happening right now, because this was a fairly aggressive correction. Maybe we get a pullback, like a rally, and we could see one more leg down. No predictions. I'm just giving you a little bit of history here that happens more often than not on strong corrections. So keep that in mind, and it wouldn't change the possibility of this just being a correction within a bull market. But I do want to point out that that's a possibility. And if that is the possibility, we want to be aware of that, so we sell this rally if it starts to fail, because there'll be another leg down. I'm going to present another couple of pieces of evidence for the bull case. And everybody knows, don't fight the Fed. If the Fed, which the Federal Reserve in the US, has been contemplating on lowering rates because their economy has been showing some signs of softening, and this is just off the press. It's brand new data out, and it was for producer price index, PPI, to the end of February. So it's pretty new information, and you can see that the survey was for 0.3% growth in PPI, and in fact, we actually got a small negative number. So you can see on the chart here, it was an unexpected negative for the market. So this could incentivize the Fed to reduce rates. And if they do, that's going to push the markets up, because The stock market just loves falling interest rates. So that's the thought as far as the bull case again. Final argument for the bulls is that the market is definitely oversold. And I talked about this last week. There is no doubt the market's oversold right now. This rally that we started seeing the last couple of days of last week will likely move a little bit higher. How much higher, I can't tell you, but we'll make some guesses in a moment. But I do want to point out that the market's been running along its lower Bollinger Band. In other words, it's 2 standard deviations past its previous movement. So it doesn't last forever when you get that much of an extreme movement. We also have a stochastics indicator showing us that it's right at the bottom of its normal range. And so we're likely to, that was showing very oversold, and we're likely to get a hook up. You can see that whenever you get these periods where it's operating at a very low level, you get a hook up. And then finally RSI, which is definitely oversold. And the last time I've seen it this oversold was again, August, around the summer of last year. And you can see it got quite oversold, and it staged quite a nice bounce. Those are 3 indicators that are suggesting, as I mentioned last week, that we get a rally. We're getting that rally, but I think because we're only starting to see a rally right now, you zoom in here and you can see that we barely moved. I do think that the market is actually going to stage another leg or so up before this rally is complete. Okay, now the bear case. So let's say we continue seeing this rally. Should we ride it and say, yay, the bull market's back? Or should we maybe be selling the rips, as I like to say, buy the dips and sell the rips during a bear market? And that's possibility of being the correct strategy. And I'll tell you why. On this chart, this is a very near-term chart again. We're looking at near-term stuff here today, folks. I've presented all the longer-term evidence in earlier videos earlier in the year, but I just want to sort of take a look at what might happen now. So the 50-day moving average is this line here, and you can see that the market's not always held by the 50-day moving average, but I can tell you, having done this for 35 years of my life, I can tell you that often markets, when they fall, will retrace to the 50 days. So in other words, when you see a correction, they often find at least a 50-day move, even if it's in a bear market. So when you see a retracement, if the market's moving down, you'll often see a retracement back to the 50 and then another failure. So we've seen a break of the 50-day moving average, but more importantly, and this is extremely important, and I'm going to zoom in here, more importantly, the 200-day moving average has been broken. So I have rules that say, when the last low was taken out and the 200-day was taken out, and that lasts for at least 3 days, I will look at it up to 3 weeks, but I'm at least going to give it a week, and I have. So I have evidence that the market is possibly entering into a new bear. Now, it's not complete evidence because we then have to see on the ensuing rally, which you always get after a big move like we've had, where will it go? So I'm just going to erase my lines here and point out that the targets right now for this rally would be the 200-day, which lies around 57.40 at this moment. And remember, moving averages are dynamic. They're constantly moving, so that's not going to be the same price a week from now. But 57.40 is the 200-day moving average level as of March 15th. And the 50-day moving average has come down to around 5,900, just a little bit below 5,900. So the market could, on this rally, move back up to the 200 and fail. But if it breaks the 200, it could find resistance at the 50-day moving average and fail. So if we see failure at either one of those moving averages, I am going to be selling. I can't advise you what to do, but I can tell you we're at about 23% cash and we will sell more. Now, my feelings are that it will probably break through the 200-day and it'll probably get close to the 50-day moving average, but that's just an opinion, and an opinion is worth as much as it's, you'll pay me for it. So that's just an observation based on long-term history that often markets in a bear market fail at the 50-day moving average. So if that's what happens, I'm watching for that, and I will sell on a negative test. In other words, a test and a failure at either one of those moving averages. And the other thing that's of interest is the 50-day lies right around the old trough, which becomes new technical resistance. So keep that in mind, that around 57.40-ish, give or take, I should say around 5,900, I should say. Around 5,900 is an important point for the market. If it moves through that on the upside, I'm actually going to suggest that this was just a bear I shouldn't say a bull market test, but if this area around the 5,900 or so on the S&P fails and the market falls, I'm actually going to be raising cash because that is our discipline. Now remember, I'm all about probabilities. I don't know what's going to happen. Nobody does. But I have been following this system, and it's in my online trading course. You can follow it for a long time, and we do outperform the market. As I explained earlier in the video, we've been outperforming in this environment. We are positive on the year and month to date, even though the market's down about 10% on the year. So I know the system works, but it doesn't work all the time. But these are my strategies and how I do things. So I'm passing that on to you, and I do hope that offers some suggestions. I can't give you advice, but I can tell you that you should keep an eye on these levels and make your own decisions from there. The final thing is that I want to talk a little bit about, well, what do we own and how did value trend make a positive return year to date when the markets were falling? Well, I'll tell you how. We were buying, and by the way, all of this stuff is on my videos and blogs, so you can go back and see that I'm telling you exactly what we did because I was talking about it on the blogs and videos. So we have been holding US Treasury bonds, which actually went up a bit, even in the down market. We've been holding things like nat gas, and that's been very good. So nat gas producers, you guys know that I was all over that trade a couple months ago, did a whole video on it. We have been inkling into some of the metals. We just started moving into metals, but we've also been focusing a lot over the past year on gold and silver. In fact, we have a pretty big piece of our pie in gold and silver. And as I mentioned, we've been involved with value stocks over growth stocks. We are very light on growth stocks and very heavy on value stocks. And finally, again, we hold a lot of cash. Almost 25% of our portfolio is cash. So all of this stuff has both protected us and actually made a little bit of profit for us in a bear market. And that's how you want to do things during times like this. You want to hold the right investments, and you want to be selling the rips if they fail at certain moving averages and certain resistance points, and buying the dips because you can trade in a market like this. So I hope this video helped. I hope it's given you ideas on where we should be looking at key inflection points on the stock market over the coming week or two or three, and how you might want to consider strategizing with your own cash. If you've been following my videos, you may have raised some cash. So the question is, do we raise more or do we buy? The question is only answered by the market. We're going to have to see what it does and move according to what the market does. I never predict, I only prepare, and I suggest you do too. Hey, thanks for watching. I hope you got value out of this episode. Please like and subscribe below. We're trying to grow the channel, and it would really be doing us a big favor. I'm presenting ideas every week on trades that we're actually looking at value trend. And by the way, I don't just talk the talk. I walk the walk. I have been a portfolio manager for 35 years. And in fact, I was one of the very early pioneers in technical analysis here in Canada. On my website, valuetrend.ca, you will see a link for our online trading course. And this course is a complete money management system. I do encourage you to take a good look at that and consider taking it. I priced it extremely low because I want retail investors, that's you, to take the course and get value out of it. It's literally my 30 plus years of experience put into one complete step-by-step course. And honestly, I wish that I had had something like this when I was an early investor. It really will stop you from making so many mistakes. I also suggest you subscribe to our Never Miss an Opportunity program, which is our blog and our newsletter. There, you're going to get ongoing ideas, tons of charts, lots of trading ideas. And by the way, we never, ever solicit. We don't send you junk spam and stuff like that to try to get your business. It's for information, because part of my passion is to teach retail investors how to invest properly. I've been doing this, as I said, for 35 years, and I hope that I'm able to pass on some of the things that I've learned through this career as both a pioneer in technical analysis in Canada and a longtime portfolio manager. Thanks for watching. Don't forget, push like, push subscribe. See you next time.